Last week, I made a video on how I'm long GLD at year-to-date highs, and then I'm down in that investment right now. So I want to update you and explain why I'm not the least bit concerned, as well as how you can invest in gold at below current market prices and get paid for it in the process. Hey everyone, Tom Gentile here. Last week, I showed you charts on oil, the US dollar, and even a seasonal chart showing why gold and gold stocks have been down in the past month. Now, if you missed this, I'll have a card in the top right-hand corner of this video for you to click on and see the details. But for this week, let me show you the most important chart of last week, as well as how to get paid to buy gold and gold stocks at a discount. Now, remember this chart? This is the 100-day chart of GLD. And it's important to understand that while this has been in a downtrend for some time, it's been double bottoming recently around the 175 area, and potentially a higher low is now forming. It seems to be trying to crawl out of the position it's in. Now, if your longer term outlook for gold is bullish, then continue on, because I showed you last week also a limit order that I used with Robinhood. And this is an example of buying if you wanted to set up a trade to buy gold at 175. And you can see there the limit price, the shares, market hours. And this was set up as a GTC, or a good till canceled order. But Robinhood sets it up where it cancels in 90 days if it's not filled. There's a chance I won't get filled on this. But there's another way to do this to get paid to buy GLD at 175, regardless of whether you get filled at that level or not. And I'm going to do that using a put option, but not as a buyer, but as an open seller. Now, most people know that buying a put option gives you the right to sell the underlying instrument for a set price for a set period of time. It's a bearish strategy that requires you to pay premium. But who's on the other side of that trade? The other side of that trade is the seller. And that is someone who thinks the asset is going to be stable. Therefore, they're going to take your premium. They're also going to take the obligation to take the asset at the agreed upon strike price. So, I wanted to buy gold at 175. How much can I get paid to obligate myself to buy GLD at 175 right now? Well, this is an image of selling GLD, or selling the puts on GLD. And what you see here is you see the setup, the current strike price is 175. All right. It also shows me things like the chance of a profit, which is actually close to 78%. That's good. Looking at the current share price, we're well above the 175 price. This tells me that I should be able to receive $180 for every contract of this particular option that I sell. Now, this option has a January 19th, 2024 expiration date on it. So that means that I'm obligating myself to buy gold, or buy 100 shares of GLD between now and January 19th, 2024. I get to keep this premium regardless of whether GLD goes up, down, or sideways. And I can close the trade out whenever I want to prior to the expiration. So that does give me some control. But if I do that, I won't receive the full benefits of the premium. Now, what the plan is that if gold goes up or gold goes sideways, or even if gold, GLD is what I'm talking about here, goes down, as long as it remains above 175 by my January expiration date, I get to keep all of that premium, and I can do it again. I could sell again and continue to sell. If GLD does go below 175, I still get to keep the premium. And guess what? I also get GLD at 175. So I got premium to set myself up to buy GLD at 175. Now, I don't just sell puts on anything. They have to be first-class companies or commodities like GLD. Here are my top 3 rules of put selling. Rule number 1, I want to sell puts on stocks or ETFs that I want to own at below market prices. Again, GLD is trading above 179. I want to own it at 175. And right now I can be paid $1.80 per share, or $180 per contract, to own GLD, to be obligated to own GLD at 175. Rule number 2, I want to sell puts on stocks that have higher than average implied volatility. Now, in the stock market, when we look at companies, we can take something. I have something called the morning report, which is free to everybody. That's at tomsoptiontools.com. And it allows us to look at expensive options. These are optional stocks that have higher than average implied volatility. What this does is this gives you the ability to take in more than average premium on certain stocks. You just have to be choosy and choose what stocks that you would want to own, and then look at what you're getting paid for those below market put strike prices. And then finally, rule number 3, I want to sell puts that give me a high statistical probability. The higher, the better. Now, with our GLD example, selling those 175 puts right now has a statistical probability of profit of around 78%. Do you know, in the stock market, I look for stocks and I look to sell puts on stocks below market price that have average probabilities of 90% or better. So these are my 3 rules that I use for put selling. One more thing. I use this as a cash secured strategy only. So I never sell more puts than I can take if I then get obligated on the stock. Basically, it means I do not over leverage the strategy. I don't over leverage this, because that's where traders go wrong, when they over leverage or they put too much money in the pot with any trading or investment strategy. Now that I've shown you how I sell puts, tell me about your thoughts on this strategy. It is one of my favorites, not just in gold and commodity ETFs, but also in the stock market too. I'll see you on the next video.